And we are live. Hello, and thank you for joining us for today's webinar. For those of you who may not be familiar with Source Advisors, we have helped CPA firms and their clients maximize specialized federal and state tax incentives for more than 4 decades. We are headquartered in Fort Worth, Texas, where we collaborate with accounting firms throughout the country to bring R&D tax credit, cost segregation, LIFO, 79D, 45L, state and local tax, as well as property tax solutions to their clients. Just a few housekeeping items before I introduce our presenter today. There will be 4 polling questions throughout the presentation. You will need to answer at least 3 of the polling questions and attend at least 50 minutes of the session as measured by the presentation software to qualify for CPE. CPE certificates will be emailed to you in the next 3 business days. Additionally, you can now download the PDF of this presentation if you would like using the handouts icon. And finally, I'm happy to introduce our speaker today, who's Kamal Shah. Kamal, I will hand it over to you.
Thanks, Ann. Hi, everyone. My name is Kamal Shah. I am the Managing Director of the Source Advisors State and Local Tax Group / Sales and Use Tax Group. Before I begin the presentation, I want to give everyone a quick background on myself. So I am a CPA by trade, but I am a lifelong 20-year state and local tax professional. I started my career at PwC. I spent about 5 years there working in the same state and local out of the New York Metro offices. And then in September of 2011, my partner, Chris Vignoni, and I started building out a practice of about 20 state and local tax professionals that are located all over the country that advise clients on various state and local tax issues. Because of the post-Wayfair nexus environment we find ourselves in, about 85% of our work right now is probably in the sales and use tax space. However, we do state income tax work, gross receipts tax, all the other types of ancillary taxes that people have to deal with on a state and local tax from a state and local perspective. In addition, because our tax area that we work in is so hyper-focused, we work with clients across the country and in all different types of industries, as well as all different types of jurisdictions. So we have, people located. I myself, I'm out of New York Metro. We have people out on the West Coast, people in Texas, Maryland, Pacific Northwest, and we do everything from compliance, which is filing the returns, all the way up to controversy work, audits, offense, letter rulings, software implementations, and we'll touch upon a few of those. But just before we go into that, I wanted to mention that, our group works in all these different areas. And I'm going to talk today about what CPAs need to know to be dangerous as it comes to sales and use tax. Sales and use tax is a pretty, it seems like a simple enough term, but what a lot of people don't realize is that sales and use tax impacts every aspect of their business, because every sale and or purchase can be under the right circumstances, subject to sales and use tax. So let's go through the presentation. Okay, so here's the agenda for the presentation. I'm going to give you guys a quick background of the sales and use tax world before the impact of the Wayfair ruling, which was in June of 2018. Then we'll talk about some of the essential sales and use tax concepts. Sales and use tax doesn't operate like GAAP. Or doesn't operate like the IRS regulations. So it is a bit complicated for CPAs to understand how to apply the different rules and what rules they need to be concerned with. So I'll walk you guys through what I believe are the 2 most essential concepts. And if those 2 concepts are, if you can kind of follow those 2 concepts as it relates to different transactions, you're well on your way to understanding the sales and use tax ramifications of different issues. How are CPAs offering the different sales tax services, right? As I mentioned, it impacts every aspect of a taxpayer's business, or it can. So what are the different services that CPAs can offer to help their clients in simplifying their sales and use tax needs? And then how do sales and use tax overpayments happen? Too much of our conversations focus on underpayments and making sure that there's no liabilities, because you don't want the state to get you, or you don't want to get audited or anything like that. But now, because of the misapplication of all the different laws that exist, there's a lot of overpayments happening, and what can be done to get those overpayments back. And then finally, halfway through the year, what are the different sales and use tax updates that are going on right now? Because although Wayfair is 7 years old, we're still seeing changes related to Wayfair happening on a month-to-month basis. Okay, so before Wayfair, funny enough, the letter of the law was based on a Quill ruling, and that was a ruling between Quill in 1992. Quill was a company that delivered office supplies, and they had a mail order business right back in the 90s. They delivered office supplies all over the country. And in 1992, there was a ruling between Quill and the state of North Dakota in which the Supreme Court basically said that you have to have physical nexus. In order for a state to require that a business collects sales and use tax, they have to have physical nexus. And physical nexus, it sounds a little complicated, but it means you have to have a presence in the state, which means you can either have a presence by having an office, maybe you're headquartered, warehouse, data center, something like that, or you have people in the state, which means maybe you're not headquartered in the state, but you have a lot of salespeople visiting in the state because it's a sales territory, or you're a company that provides maintenance type of services, and you're located in one state, but you have trucks that travel throughout the week to a bunch of different states. Outside of those two instances, just because you're having someone drop ship something in a state, that doesn't mean you should be required to collect, right? So what that meant is physical nexus is the only way you could be required to collect. And what that meant is that most companies with less than $100 million in sales had a very limited physical footprint. And so they only had to collect sales and use tax in a handful of states. So maybe you're located in New Jersey, but you have an office in New York or in Pennsylvania or Connecticut, or on the West Coast, you have a couple offices in California and Arizona, but you have 100 million in software sales. You only had to collect in the two states where you had a physical nexus. States obviously didn't agree with that, so they tried a bunch of different things to get around that. They tried saying, hey, click through. What about cookies, right? When you go on a website and the website downloads a cookie so it remembers you in the future, does that count as physical nexus? What about affiliate nexus? When you have somebody working on your behalf or they're getting a commission, can't that count as nexus? And the state basically said, nice try. We're not going to count that. A couple times. It made its way up to the Supreme Court. Again, the Supreme Court said, nice try, but we're not going to, no, it's just physical nexus. The 92 ruling stands. What started that kind of shaking that is in 2016, the state of California reached out to Amazon and said, you guys have this service called Fulfillment by Amazon, where you collect and you hold on to revenue or inventory on behalf of the companies that you're selling for. You sell on behalf of those companies by holding on to their revenue in California. And doesn't that mean that that company has a physical presence in California? Now, California had not gone out and gotten a ruling on this. They just tried this. And Amazon was like, you know what? Kind of makes sense to us. Sure, we'll start collecting on those. And that made states get a little aggressive. And then what that led to is in 2017, and the state of South Dakota assessed Wayfair. Wayfair, for those of you who don't know, is a furniture company, home goods company that sells, they're based out of, I believe, Massachusetts. And they sell goods all over the country, primarily through their website. There's, to my knowledge, one or no stores, and they were selling a lot of goods into the state of South Dakota. South Dakota said, "You guys are selling a lot. You should be required to collect tax," knowing that the rule was in place that said that they couldn't be required. It obviously made its way up through the South Dakota Supreme Court, and the state kept losing every single step of the way, and then it made its way up to the Supreme Court. And that leads us to the ruling that took place on June 21st in a very tightly divided court, 5-4. Kennedy, joined by Thomas, Ginsburg, Alito, and Gorsuch, right? Kind of a broad array of ideologies over there that basically said, you know what? The gist of it was, this is not 1992. This is 2028, and businesses are very different nowadays. You can have a company having no physical presence in the state through the use of delivery companies like FedEx, UPS, and through the use of social media and other digital marketings have a significant presence in a state without ever having a physical presence in the state. And there needs to be some sort of accountability for that. And that's for the state to ask, for the state of South Dakota to say, you know what, you should be collecting tax to the things that you're selling in our state because you are using our infrastructure, right? The delivery trucks have to use the roads. The digital gets used the electricity, the telecom, all those. So you should be contributing to that. And the only two exceptions that the court's decision put into place is they said there was a rule in place from 1992 that stands. We're not going to sit there and go retroactively. Our ruling is effective June 21st, 2018, because there were Massachusetts, Hawaii, and a couple of other states had a ruling go up to the Supreme Court that they had lost, and they said, nope, all those old times when you guys lost between 1992 and now, those losses still stand, and we're not going to apply anything retroactively. And the other thing is, we don't want to penalize small business, and for reasons that they didn't really opine on, they said anything less than 100,000 in sales or 200 transactions by a company is a small business, and they shouldn't be required to collect tax because that's a little too much of a burden on small businesses. But other than those two things, there were kind of no commonalities in how the states decided to move forward. Now, all the other states, because 45 of the 50 states have sales and use tax, were watching the guidance come through the way. And by the end of 2019, most states had their economic nexus rules in place. And Florida and Missouri were the last two holdouts, but they finally had their rules in place by 2023. Okay, this is kind of an interesting slide. This is information that we got directly from the state's websites. What a lot of people don't realize is that in the 45 of the 50 states that have sales and use tax, 25 to 35 of the operating budget that the state gets each year comes from their sales and use tax. So any changes to the sales and use tax guidance that impacts the revenue coming in has a significant impact on how the states operate. So all the numbers on here, 12 of the numbers on here are directly from the different states' websites. And what it does is it compares the revenue from 2 5-year periods. So the second and the third column are showing in billions of dollars the sales and use tax revenue collected in 2012 and in 2017 in those 4 states, in New York, Texas, North Carolina, and South Dakota. And what you see there is there's a growth in the revenue over a 5-year period, but that's a normal population-related growth. New York, right, stagnant on the population. Texas, North Carolina, South Dakota having population growths, as well as normal price increases. But where you really see the difference is when you compare the 2017 column to the 2022 column, because what happened is now you have so many more companies that are being required to collect tax, sales and use tax in sales that they're making remotely. Maybe they're a SaaS company that are selling remotely. Maybe they're an e-tailer that just drops goods in the States. We have foreign companies that have no U.S. presence, but have, 50, 75, $100 million of sales in the U.S. that now are collecting or have to be required to collect sales and use tax. So you see the significant increase between 2017 and 2022 in the revenues collected, right? New York, 41% increase. Texas, North Carolina, again, around 50% increase. And South Dakota, the state that kind of started this all and pursued it all, so almost a doubling of their revenue year over year from their sales and use tax sources. So definitely a very fruitful endeavor for the states. And, the Supreme Court didn't require the states to collect sales and use tax based on economic nexus. They basically said you can. And as I mentioned in my last slide, every state very quickly said, yeah, we'll get in on that. So it it was optional, and every state elected because of the drastic increase that you see in the revenues. Polling question number 1, right? And what was the small business exemption that the Supreme Court applied to its decision in South Dakota versus Wayfair?
They are starting to come in. Looks like we have a majority. What is the answer?
The answer is C, 100,000 in sales or 200 transactions, because again, they didn't want, they understood, if you're a marketplace seller or if you're doing a little bit of small sales all over the country, you shouldn't be required, because there are, when you include local jurisdictions, there's almost 12,000 sales and use tax jurisdictions. So now life after Wayfair. Now, yes, we talked about the $100,000 rule a couple of times, that being the small business exemption, but that's the only kind of area that they agreed on, because that's the only rule that the Supreme Court put in place. There is no lack of uniformity in the economic nexus rules. So the dollar amounts thresholds vary. What does that mean? That means that the Supreme Court said it has to be 100,000. 40 of the 45 states said 100,000 is fine. Alabama and Mississippi have it at 250,000, and California, New York, and Texas have it at 500,000. Some include transactions and some don't. It's at 100,000 or 200. That's getting complicated. So more and more states are just dropping that transaction amount and just going strictly based on a dollar amount. But some states still, I think about a third of the states still include the transaction, which means, if you're selling, coffee cups and you sell 500 cups in a state, but you're selling them at $5 a pop, technically speaking, you have economic nexus in the state, because if that state relies on a transaction count, you're over the 200. Then what's included in the threshold? Economic nexus doesn't talk about having a liability. All it's talking about is being required to collect in the state or not being required to collect and file in that state, which means that if a state says that in their sales count threshold, right, that 100,000, 200,000, 500,000, whatever it is, they're going to count gross sales. If you're a company that's primarily selling 80% of your sales, 90% of your sales are sale for resale, but if you're operating in a state where your gross sales are included, you could be required to collect sales tax on a very small percentage of your sales because your gross sales are over the 100,000. What about marketplace sales? Some states marketplace sales count. What does that mean? That means, we have clients that are retailers that 90% of their revenue is done through Facebook or Etsy, but 10% because they're trying to build out their brand recognition, they have a website. Now, even though their website makes up, I have a client that 3% of their sales are done on their website. 97% of their sales are done through different marketplaces, but they still have to collect sales tax in many states on the 3%, because in those states, they combine the marketplace, which is the Facebook type sales, with your other types of sales and figuring out whether you're over that amount. And then when does Nexus begin? Is it on the next transaction? Some states said, yes, you should be monitoring your sales. And when you know you're going to come to $100,000 or whatever the number is, you should be ready to register so you can start charging sales tax the very next. That's a little impractical. Other states have it at the next quarter. The other end of the spectrum is New Mexico, where once you file Nexus, once you meet Nexus filing thresholds, you have to register the following January 1st. I'm working with a client right now that met Nexus in February of 24, but didn't have to register till January of 25. Again, very, very different rules state by state. But the end result, as it shows in the green tab over there, is that the end basis is before you had a company with 100 million in sales had to file in 2 or 3 states. Now we have, companies with 10 million in sales having to file in 30 states, because in most states it's based on $100,000. And if you're an e-tailer, or if you sell some type of SaaS service, we had a company that was selling cookies, right? Something very simple. It's not that hard to hit 10 million in sales and having requirements to collect in 20, 30 states. And because of that, you're probably going to need a technology solution, because it's not easy to keep up with all these things. Every state now has a marketplace facilitator law. That's a good thing. What's that talking about? That's saying if you're selling on a marketplace facilitator like Amazon, then Amazon is going to be required to collect all the sales tax for all the people that sell on their platform. That makes it easy, because now the state doesn't have to monitor and process thousands of individual tax returns, and thousands of businesses get that time back because the state's allowing the marketplace facilitator to do that. But again, as with everything else, the marketplace facilitator rules do not carry over from state to state. So if you're a company based primarily out of Colorado, you're going to have different marketplace facilitator rules than a company out of Massachusetts. So you have to monitor that. Okay. Attempts for uniformity in sales tax have ceased for all practical reasons. What is that's basically referring, before 2018 ruling, the states had to make it easy for different sales and use tax rules to kind of be in sync with each other, to make it easier for businesses to follow, because sales and use tax was very, very complicated. And the federal government, had basically said that they weren't going to get involved. So you wanted to make sure to make sales and use tax laws simple enough for businesses to follow, because you knew that you didn't have any enforcement level from the federal government. And now that's changed. The SSTA, which was the Streamlined Sales Tax Authority, it exists, but they haven't added states in a year. That was a collection of states that were trying to come together to make rules easier from state to state. There's no new federal bills to create uniform filing standards. Don't forget, these were all efforts to create a business environment and encourage companies to voluntarily comply. And now they don't need to voluntarily comply. Sales and use tax is a trustee tax, which means a business owner can be held liable. And now the federal government has said, even without having a physical presence, you're going to be required to collect. So it notched up the level of guidance from the federal level, which means that now the states can be a little bit more challenging and a little bit out of sync with each other. And it doesn't matter. Business owners will still have to be compliant. And the last point there is local sales tax applications of Wayfair is still a mystery. Some states like Colorado, Illinois, Louisiana, Arizona, states that have a strong home rule basis where the local jurisdictions often don't follow what the state does. A lot of the localities have not come out with where their economic nexus threshold rules are going to lie. That's changing, the further away we get from 2018, but that's still one of the areas of mystery. Polling question number 2. Oops, there it is. The following was a result of the South Dakota versus Wayfair ruling. And the trick there is the word accept.
Okay, looks like we got almost everybody. What is the answer?
The answer there, because again, the trick there is B, except all states agreed to a unified sales tax collection process. The states didn't agree to a unified collection process. All they agreed to is that they were all going to collect sales and use tax based on the economic nexus rules. They didn't agree to the dollar amount, right? 100,000, 200, 500,000. They didn't agree to when they're going to base it on. They're going to base it on gross sales, retail sales, what type of sales they're going to base it on, when they're going to start doing it. Some do it based on a calendar year. Some people do it on a fiscal year. So there's really no sort of consensus. That being said, with Wayfair behind us, I'm going to go through some of the essential sales and use tax concepts. I think the 2 most essential concepts in sales and use tax world is understanding that the way sales and use tax is that in most cases, the way the law is written, although there's no kind of commonality across the states, is the general rule of thumb is tangible personal property, which is anything you can touch, right? Like a pencil, piece of paper, your laptop, chairs. Tangible personal property is subject to sales and use tax unless there's an exemption in place, right? So it says what is taxable for TPP, generally taxable unless exempt by law, which means the law, the way when they wrote the law, they said things weren't going to be taxable. Most common example is real property. Real property can be subject to a bunch of other taxes, transfer taxes, other types of taxes, but it's not subject to sales and use tax because it's specifically excluded from guidances. Or certificate, which means normally this pen is subject to tax, but if I have an exemption certificate, and we'll go into that in a little bit, it's going to be exempt. The flip side is true for services. Most services aren't subject to tax, right? You go to your doctor, there's no sales tax on that. Accounting services, a lot of these services aren't subject to tax unless it's specifically written within the tax law that it is taxable. And then when it's written within the tax law that it is taxable, the most common types of services that are taxed are things that involve either repair or maintenance of, as the second bullet point says there, services to TPP is taxed in 2/3 of the states, and services to real property in taxed in half the states. That's referring to, the HVAC building, the HVAC unit in the building, quarterly maintenance that needs to be done on that. That's repair and maintenance of real property. That's more likely to be taxed. If a service is going to get taxed in the state, it might be that service. Services to TPP are even more likely. Your car breaks down, you have to get the engine repaired or something like that. If it's going to be taxed, that is a service that's taxed in 2/3 of the states. On the other end of the spectrum are business and professional services. Those don't get taxed too often. They're only taxed currently in 10 of the 45 states. And even in many of those states, like in Connecticut, for example, it gets taxed at a lower rate. So that's the first part, I think, is a very essential term of sales and use tax. And the other thing is the sourcing rules, right? When in the US, we have 50 states that can all kind of make a claim to a revenue stream depending on the different data points. So how should revenue be sourced? And so the sourcing rules that they've been put into place is that for tangible personal property, for TPP, it's taxed based on the ultimate destination. The words used within the tax law is, where is the benefit derived? So where is the benefit derived of that good being purchased? So when I bought this pen, the benefit is going to be derived in the location where I use the pen. So if I go to my local Staples is going to assume that I buy it and I use it in the area where the Staples is located. So that it's going to get taxed at that rate. If I get it delivered to my house, the company that's going to charge me the sales tax is going to base it based on the address where my house or my office is located, because they're going to assume that is where the benefit is derived. So delivery method, company or third party doesn't affect that. What's that saying? Whether I go have myself pick it up, or whether I have a courier, or if they deliver it via FedEx, USPS, whatever, the address is the address. If it's getting delivered to my house, that's going to be the address. Buyer pickup at the seller's site equals origin-based sourcing. That's saying, when I go, in my example, if I go to Staples has no way of knowing where I'm going to use it. So they're just going to base the sales tax based on where I buy it. And the same is true for services, right? Services are going to be taxed where the service is received, because that's where it's assumed to be used. If performed at the customer's location, that location determines the service. So going back to my HVAC technician coming in, the HVAC technician comes in, works on the office in your the technician works at the location where your office is located. The sales tax is going to be based on whatever the rate is in that location where the office is, not where he comes from, not where the invoice is going to get sent to, where the work site is. There are statutory exemptions, right? So statutory exemptions are exemptions of products or services based on specific statutory rules. Foods, professional services, and real property, as it stands in 2025, are the three most likely areas that are statutorily exempt. That's saying that per the state's very own statutory guidance, the law that they write into place, they're usually going to put, because food and real property are tangible personal property, right? TPP, professional services are services. Usually something within the guidance is going to explicitly or implicitly make sure that it's clear that these items aren't subject to tax. And again, when it's talking about food, it's referring to grocery items. Restaurant food is most likely subject to tax in all jurisdictions, but you go to the store, you buy an apple, bread or things to make grocery items, those tend not to be taxed. Then there's non-statutory exemptions. What's that? That means, going back to my pen example, or the easiest example is a laptop, right? Those things are normally subject to tax unless the use of those things are exempt, or the person buying them are exempt from use. So going backwards, why would the person buying it be exempt? In many states, it used to be the case in all states, it's kind of back away from that. In many states, 501c3 entities, those are, your healthcare or education-related not-for-profits, have a not-for-profit exempt use, which is an exemption certificate that they fill out with their illegal ID number and everything. And anytime they buy something, they give it to the vendor, and the vendor knows not to charge them sales and use tax. There's other ways there's other exempt uses also. There's a resale. What does that mean? If you're in the business of selling pens, you shouldn't have to pay sales tax because you're just a buyer and a reseller. So then you issue a resale certificate to the person you buy it from, and you collect sales tax from the person you sell it from, unless that person provides you with a resale certificate. There's no cap on the number of exemption certificates that can be issued. It's possible that you can have 5, 6, 7 different exemption certificates. Laptop gets made in Taiwan. It goes from one reseller to another to a reseller all the way down. And then if the final purchaser is let's say a not-for-profit, a school or something, the entire lineage could have exemption certificates, and there could be no sales tax charged on that. And then that last exemption is probably the most common exemption that we see, and it's called the manufacturing exemption. And it's referring to anything that equipment, raw materials, or even the energy that gets used to produce something else, that's all exempt. The only thing that's subject to tax is that final thing that's made and sold to somebody. So if you're a manufacturer and it's called a manufacturing exemption, but it's pretty broad. In some states, actually baking and producing goods by restaurants and others that sell it, not restaurants, but the like grocery stores that sell, dinners, ready-made dinners, things like that. Those can be subject to the quote unquote manufacturing exemption. So, and in there, again, it's everything. It's the equipment, the materials, the energy, everything gets included in that. Okay, how are CPAs handling Wayfair? Historically, Source Advisors we typically work with hundreds, if not thousands of different CPA firms across the country. So we ask the CPA firms we work with, how exactly do they handle their sales and use tax filing or any kind of assistance that they give their clients? How do they handle that? And this is kind of the answers that we've gotten. 25% of them, about a quarter of them, they do everything in-house, right? It's one of their suite of services that they offer their clients, and they do everything, meaning from compliance, audit defense, software implementations, nexus studies, voluntary disclosure agreements, everything in-house. Then a third of the firms we work with, about 35%, do some of it in-house. And that's usually around geographic favorability, meaning if they're located in a certain part of the country, they don't mind answering sales and use tax questions as it pertains to that area, or maybe a couple of industries that they're familiar with. But outside of that area, they like to outsource the things out because it's outside their wheelhouse. And then the remaining about 40%, it's just not something they want to get involved with, and they just outsource it, everything. And so that's kind of the mixed bag of things we've seen. And when they outsource it, or when they fully insource it, or even if there's a mix, we try to figure out what are the different services that are being offered. And it's all pretty much, no matter what they do, this is kind of the suite of services that gets offered. Too often sales and use tax is thought of as one tax. But again, as I mentioned a few times, because it hits every single part of your business, there's a lot of different things to consider. So the 7 items here, and then the 2 I'll kind of jump in at the end, are kind of the normal life cycle. Post Wayfair, what would happen is you'd have a company 5, 10, 15, 20, 30 million in sales that didn't pay attention in Wayfair, and now we're trying to figure out how to become compliant. And the way the process normally would start is a nexus study is done, right? Their overall sales, domestic sales, are analyzed to figure out where do they have a nexus footprint. And nexus, again, just means where they're required to file. There could be different reasons, and that's what that second step does, the liability analysis and mitigation. Okay, we figured out that you need to file in 15 to 20 states. And in some of the states, the statute of limitations is 3 years, and some is 4 years. But let's see, what is the liability that you have? Maybe do you have a lot of not-for-profit sales? Do you have a lot of manufacturing items that could be subject to the manufacturing exemption? A lot of resale type sales. Maybe you sell to larger companies, which are more prone to having use tax analysis process, so there's no liability there. Let's figure out a bunch of different ways to see if we can lower the liability. Once we finalize the liability through the liability analysis and mitigation process, we'll come forward under a voluntary disclosure agreement. VDAs, they used to be kind of used off and on, but now, again, post Wayfair, every state in the country has has a voluntary disclosure agreement program in place. And as with everything, there's no kind of commonality, but the 2 or 3 most common things is that every voluntary disclosure agreement will reduce the look back period, which means if you had a company that had economic nexus back in 2018, 2019, in 2025, you're talking about 6-7 years open. A voluntary disclosure agreement, one of the prime incentives is it reduces the look back period to says 3 to 4 years. State says, thank you for coming forward. You'll have to pay it back for the period that's open statutorily, because that's what anybody who would get audited would have to do. But anything past that, we'll kind of let it go. Just be honest and file moving forward. That's the first benefit. The second benefit is, hey, if we would have found you on our own, not only would we have an unlimited look back, we also would have charged you a penalty. The penalty could be anywhere from 20 to 30, 35%. We're going to waive that penalty. It's called penalty abatement. That's the second benefit. And then the third incentive, which they used to have, which is unfortunately being taken away, is they used to waive the interest or reduce the interest. But with interest rates and prime being what it is, that's kind of no longer becoming the case. As a part of the voluntary disclosure agreement, we'll do the sales and use tax registration. The sales and use tax registration is a separate registration than the business license registration or any other registration. And the reason for that is because within that registration form, it's going to ask you for, quote unquote, the responsible person. The responsible person for sales and use tax is the person that, when you write down whoever that person is, you're gonna have to put down an identification number, social security if they're local, if they're a U.S. citizen, if they're a foreign national, usually a passport identification number. And why it does that is that's the person is going to be held personally liable if the business goes bankrupt and isn't allowed to pay any sort of outstanding liability. So that's why, one, it requires its own registration, and two, you want to be careful about who you want to put. It's usually a business owner and officer. Then the next thing is, okay, now you're registered, you're required to file and collect, but are your goods and services being taxed correctly? Do you need a taxability matrix? If you're selling in 40, 50, 45, if you're selling in all the states, and there's 45 states with sales and use tax, and you have, although the state level taxes in most cases is the same with some of the strong localities, like in Illinois, Chicago doesn't necessarily follow what the state does. New York City, 90% of the times follows New York State, but it doesn't follow it all the time. So you need to make sure you have a taxability determination matrix where all of your goods and services are being taxed correctly. If you're selling software, it's maybe taxed in half the states. Are you taxing it in the correct states? And are you making sure that you're charging the right rate? And that doing those things, because there's 12,000 jurisdictions where even if a certain state's taxes software exactly the same, each state, because there's the state rate, the county rate, the city rate, might be a school jurisdiction rate. There's different rates. There's up to 12,000 different rates depending on the country, the area of the country. So you need a technology solution to make sure those things are being done correctly. And then once everything is done correctly, sales and use tax compliance is either monthly if you're submitting enough tax, quarterly, or annually. And you have to file those returns even if you don't have sales in a specific time period. Maybe you're a software provider and you bill your customers once a year, but you bill them $100,000 for a software. Now, that $100,000 is probably over the amount that you're required to file and collect on a monthly basis. But even though your sale is done once a month, the other 11 months, you'll likely be required to file a zero-due return because that's just the way the law is across the country. So we assist with the ongoing compliance. CPAs can assist with that. And then the last two things are audit defense. Any one business getting audited in a given year, odds are very small, but over time, as businesses grow, the likelihood just increases. And some CPA firms do this, some don't. We always advocated, but in conjunction with an audit defense, a reverse sales and use tax audit should be done. A reverse sales and use tax audit does exactly what the state auditor is doing, but it's just looking for the underpayments, it's looking for the overpayments, where the auditor is looking for the underpayments. Polling question number 3. Oops. Purchases by manufacturers that are exempt by most states include.
We have most of the people responding. What's the answer?
The answer is D. Materials that become, the raw materials, manufactured equipment, and the utilities. Utilities is the one that most people typically forget about. The energy used to make the finished good is also subject to that same exemption that the other two are. Okay. Is there any good news? Good is a bit of a stretch, but as it relates to any kind of tax, but yes, there is some good news if you want to call it that. Due to so many new companies collecting and filing sales tax returns, the overpayments companies are making is skyrocketing. Why is that? Because if a company has to make a decision on how to tax something, and there's a bit of ambiguity, or if they're going on the fence about whether they have nexus or any kind of gray area, it always behooves them to file. And I would always advise them to file sales and use tax because it's not a cost on them, right? I mean, obviously they have to be concerned if their competitors aren't charging it, that's one thing. But if their competitors are charging it, there's no economic disadvantage. But if they don't charge it and it's a gray area, then if they get audited in the future, that's going to be a cost to them. So if they don't charge the tax at the time of the sale, they can reach back out to their clients or their customers after the fact to get the tax. But the way the law is written is that you can't force them to pay you the tax after the fact. You're supposed to charge it when you bill them. And, you'd have to kind of sue them, and most companies don't want to go for that. So if there's a gray area, companies typically will charge, which is one of the reasons why we think overpayments are increasing. As auditors are allowed to audit companies for 3 to 4 years, depending on the statute of limitations. Companies can do the same. Companies can review all of the purchases for the last 3 or 4 years for overpayments. These overpayments can be obtained directly from the state or from the vendor. And where you have to go to depends on where in the country you're located, or better put, what state you're trying to get the tax from. On the West Coast in California, Arizona, for example, only the vendor, which is the company that collected the tax, is allowed to get the money back. So if you pay tax incorrectly to your vendor, right, you bought something, you didn't give the exemption certificate, you have to reach out to the vendor. The vendor has to say, okay, I'm going to get the money from the state. The vendor gets the money from the state, and then they give it to you. If the vendor doesn't want to do that, or if they don't agree that you do the money, you can't get the money back, and there's unfortunately nothing you can do about that. On the East Coast, New York, New Jersey, most of the North New England states allow you to do it either way. You can go to the state, you can go to the vendor, whatever you want to do. Typically, vendors we advise you can go back to for the last 15, 18 months. Anything more than that, you want to go to the state. Some states, like Georgia, for example, they require you to go to the state and ask you for, they require you to go to the vendor. The vendor has to sign a form that says, yes, they overpaid these taxes. No, we're not going to give it back to them. Then you have to take that form, and then you have to go to the state, and then the state will give it to you. So there's administrative burdens in the different states, and you want to make sure you follow the procedures. And typically CPAs can advise with that. Auditors, this is something that people don't realize. Auditors, if you're the biggest red flag we get is, hey, we were just audited and there was no assessment and the auditor didn't find an overpayment. No, auditors will never find any overpayments. I've done thousands of audits in my career, and I can count on one hand the number of times an auditor has pointed out an overpayment to me, and I'm being very generous there. The other benefit of doing a reverse sales and use tax audit is that if you find an issue, right, I mentioned the exemption certificate issue, you can make that change so it's done going forward. So corrections can be made in your business policies and procedures to make sure you reduce overpayments on a go-forward basis. And typically, those sales and use tax, when you're paying them on your purchases, that's an above the line cost savings to the company. There's no common sales and use tax rules, from state to state, but there is this one law that, hits on 6 different states that we think is a pretty unique opportunity, especially nowadays with companies moving more and more to a services-based industry. People think that there's no sales and use tax opportunities. So this is a real life example from one of my clients, and it's referring to the multiple points of use exemption. The same law exists in New York, Illinois, Pennsylvania, Massachusetts, Washington, and Utah. And it's basically, the law says that if you're a company and you buy a software, the software gets delivered to your state, but if all the users are not located in that state, you don't have to pay tax on the users that are not located in that state. But the flip side is also true. If you're a company and you have users located in that state, you should technically be accruing use tax. But the way it works on the refund side is this. New York headquartered professional services company has 400 employees. 150 of the employees are located in their New Jersey office, and 250 are in their New York office. This company specifically was an insurance brokerage company. So with the actuarial software and everything, they're spending about $2 million a year in software, which was all getting delivered and taxed to New York, right? Going back to my whole sourcing rules things, because that's where the software was being billed to. Their IT team was located in New York because that's where they were getting all their laptops prepared. So you had $2 million in purchases for the 3-year period because the statute of limitations in New York is 3 years. So now you have $6 million at 8.875. That's the tax rate in New York. They paid $533,000 in sales tax. 150 of their 400 employees, so about 37.5% of their employees are located outside the state. They're due a refund of $200,000. The first question someone asks is, well, don't they have to pay that money to New Jersey? No, they don't, because in New Jersey, software that's purchased for businesses, for business use, and delivered electronically, all software is electronic nowadays, is exempt. So this was a pure savings to the company. Every 3 years, they do a refund for about this amount. Okay. The updates to watch for, the trends to watch for in 2025. Big talk of the year, right, with the new administration is tariffs. Are tariffs going to be taxable? Before the guidance came in, we expected tariffs to be stated as being taxable, and they are. New Jersey, Illinois, a few other states have started to publish their guidance, and basically they're saying that it's going to be taxable. Tariffs are taxable. People think it's odd because they are taxed, but it is going to be a tax on a tax. Tariffs are taxable even if they're going to be listed separately on the invoice, right? You buy something, you buy a laptop for $2,000, it gets charged. I don't know what the fee is. Let's say 25%, $2,500. You're in New York, sales tax 8875. Now the 8875 is going to be on that total amount. They are part of the sales price or the gross receipts, and you can't deduct the tariff cost from the taxable amount. That's kind of where all the states are lining up. More and more states are kind of publishing the rules on their state website. The next area that we're seeing a lot of consensus is that they're modernizing their tax base. What does that mean? The U.S., as we're all aware, is moving to a services-based business from a goods-based business. That's why when we went initially through the taxing rules, it was tangible personal property. Most of the money that used to be spent on purchasing was spent on buying tangible personal goods. Now it's the opposite. You can go buy you can buy a brand new TV, for $400 or $500. Digital goods, subscriptions, that's where we're spending our money. So that those goods are being more and more likely to be taxed. The most recent one that a lot of states are taking direction on, Maryland and Utah recently, are the most recent ones to start taxing digital goods. Digital goods are more likely to be taxed now. And the flip side is essentials are not getting taxed. Grocery store items that we talked about, personal hygiene items, they're getting exempt. And at the same time, digital goods are getting more and more likely to be taxed. And then the final trend that we're seeing is the nexus simplification, right? Way back when in the early parts of the slide presentation, we talked about the economic nexus rules being, 100,000 or 200 transactions. They're dropping that. 13 states out of the 45 states never had a transaction count, and now it's up to 27. So only 18 states now currently have a transaction count, and we expect more and more states to drop that. And this is the last polling question. When companies overpay sales tax, they can recover the overpayments in which of the following ways?
We are getting most of our answers. What do you say is the answer?
The answer is D. In an ideal situation, you can go to the vendor or the state. As I mentioned, in some states you can't, but in an ideal situation you can. And you can also find a refund claim during the audit, right? As I mentioned, if you don't want to go through the process, the one area you definitely want to do a refund is in conjunction with an audit, because one, the auditor is never going to tell you if there is a refund, and two, you're going to have to pull together the same information anyway. So you might as well just take a look through it. And then, three, one last thing that people forget is something we refer to as the interest offset. What that means is if you have a $100,000 assessment, that assessment is going to get charged penalties and interest of probably 30 to 35%. So the assessment's going to sit total amount at $135,000. If you lower the assessment by even $20,000, you find a software that was taxed incorrectly, capital improvement exemption, something just very small, and you lower it by 20%. Now that $100,000 assessment that was going to have 30% interest and penalties becomes $80,000. The $80,000 is going to have interest and penalties of 30%. So you're going to see not only a reduction in the assessment amount of $20,000, also a 30% reduction in the interest and penalty amount, because the refund claim amount and the assessment amount are netted together before the penalties and the interest is assessed. So definitely if you don't want to spend the time, understood, but it definitely makes sense in conjunction with an audit because you're going to look at the same thing and gather the same things. That brings us to the end of our presentation. Appreciate your time. My name is Kamal Shah. That is my email address and my phone number. Please feel free to give me a call if you have any questions or there's a certain area of sales and use tax or state and local tax that you want to discuss a little further. Appreciate it. Thank you.
Thank you.